Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, April 22nd, 2020. This is a midday update. It's 11:36 a.m. Eastern Time as I'm starting the video. We'll take a quick look at the broad markets and a couple other things. We'll look at gold, talk about what's going on with oil recently, and probably that should be about it. But we'll start out with the broad markets, and again, I need to constantly reiterate the benefit of using multiple time frames in your analysis. And there's a, so there's a very, very big difference between short-term analysis, short-term charts. If I'm, going off a 5, 15-minute, even 60-minute chart, any intraday time frame, that's the very short-term outlook. And those are the levels I've most frequently highlight, especially in this market. But every now and then, we need to take a step back. I'm always keeping an eye on the bigger picture. I don't talk about it every day because the bigger picture doesn't change on a daily basis. Now, what am I talking about? Well, we'll get to that in a second. 60-minute charts, same story. We broke down, sell signal triggered on that trend line break yesterday. We hit that first and very significant level. That's why it's color coded yellow, 273.39, big level right there. Again, talked about the gaps back here in the past and reactions on it. So it was really a breakout here on SPY, and we're back testing it. So we had a reaction all day yesterday, meaning we consolidated very, very tight. You don't even see candles that small for months now. That's about as tight as a consolidation. It means we hit it and it was like a brick wall or a floor, if you will. And so far the reactions continued. That was a reaction in the form of consolidation. This is a reaction in the form of a bounce, but we're still below the trend line that it broke down. In fact, we're about halfway through there on the gap. You can not even. We're really pretty much testing the bottom of the gap. Let me put a line right here. What I'm talking about is there's the yesterday's gap down. And so we're trying to enter the gap but failed to. And the way it works in technical analysis and trading, gaps are big levels. Traders watch gaps, they trade off them. The top and bottoms of gaps act as support and resistance when tested from above and below. And often, not always, but quite often, once a gap is entered from below, it'll be backfilled. So that's what's going on right now, and that's certainly a possibility today, and that's a level to watch. And as I said, I believe in yesterday's video and today, if we bounce up, you're going to have very nice resistance, a very objective shorting op. Most won't feel like shorting because they'll think, oh, the market's going back to new highs, and maybe it does. Who knows? All I can say is that's objective because you'll have the top of the gap there around 281.50 plus a back test of the trend line. And now we may never get there as well. We could certainly fail here. We bounce back to resistance, again, the bottom of the gap, and so that's that. So your objective short entries, well, right here at the gap resistance. Bounce up there to 81.50, and we're talking, not big in percentage terms really, and or a break below that 273.39. That would be a pretty powerful sell signal if it happens, especially with all that reactions, all that trading that happened there yesterday. That really helps to validate that. If I thought it was a significant level before it was hit yesterday, after 1, 2, 3, 4, 5, 6 hourly candles dancing on that level, failing to take it out, look at each and every one, the body, the fat part, you can see when they tried to pop it intra-period, boom, whipped back above it, boom, whipped back above it, closed on it, closed on it, closed on it. So that's, again, just level to watch. Now, short-term stuff. So if we go much above there, sure. If we take out 281.50, bullish. If we take back this trend line, bullish. Certainly if we take out the previous highs, bullish, especially near-term bullish. So now let's talk long-term, bigger picture. For those of you that are not active traders, those of you that are more concerned about where this market, where the next 20% or more in this market, or 30% might be, whether we're in a bear market or not, whether we had a bear market and it ended quickly, maybe the fastest one in history, I don't know. Well, we had Black Monday, 1987, where market dropped 25%, something 20-something% in one day. All right, so bigger picture, let's just take a look at that real quick. Monthly charts. So on the monthly charts, which I've shared many times in the past, again, I don't update daily because it's, you need the only signals that you ever have here, you need to see the end of the month candles close above or below, above or below the, support or resistance level you're looking at. So the big ones on this chart, covered many times. I really like this 20-month exponential moving average. Does just a bang-up job at defining bull and bear markets. Can go back, not just the last one, as long as you want to go back in history. Here's the late 80s. There's that 20 EMA acting as doing a bang up job of acting as support, telling you the trend was bullish. That was one of the, up to the time, one of the biggest and longest bull markets in history. Broke it there under, there was the 2001 or 2000 to 2002 bear market. You can see we traded below it and acted as resistance till we took it out right here. So again, I covered it many times. If you're new to my analysis, just take a look, screenshot this chart, and you'll just see how good a job it does of telling you, primary trend is bullish or bearish when the indexes are below. Yeah, sure, there's choppy periods. Nothing is perfect. There's a few candles here, a few whipsaws. But even if you traded it religiously, meaning every time you had a monthly candlestick close above it, you went long in your 401k, your long-term funds. And every time you had a monthly candle below, sure, you would have had a few whipsaws over the past 30 plus years, but you would have vastly outperformed the stock market, vastly outperformed it, especially if you went short, closed your longs and went short, and captured the those big bear markets of over 50% the last few. So where are we at right now? Well, we took it out last month, solidly closed down below it. That's not a maybe close signal like a lot of these back then when you had these closes right on or just below. They were questionable. Like I always say, when you have a breakdown or breakout of a stock, the more impulsive it is, the more solid the candle, the higher probability to sell signal. So this one was unmistakable. And what have we done this month so far? We kissed it in April, made a perfect. And I can't move this line. You can't make that up. Look where SPY stopped so far. Rallied up, tested it from below. So far has been rejected. But there's a lot of time left in the month, so we'll have to see how this one closes. And then you also have my, I have a couple primary trend lines. This is my BOD, benefit of the doubt, bull market trend line, the white one there. Comes in off the 2009 lows, catches that 2018 low, and we took that out as well, and we're currently flirting with it. So again, to be continued at the end of the month, but as of now, all we can say is we had a sell signal last month. Does it prove to be a whipsaw? And only time will tell. But if you want to stick to this again religiously, you say, well, the broad market, the S&P 500, probably the most representative index of the stock market, is on a sell signal at this point in time. And again, if it changes, then it's a whipsaw, and so be it. So let's look at a few others. You also have the Dow. A lot of people like to track the Dow. It's only 30 stocks instead of 500, so I think S&P 500 is going to be a little more representative of the economy and the stock market, but same story. You can see that 20 period exponential moving average, defining bull and bear markets. You can also see, the common theme. Bull markets tend to have a nice, well-defined uptrend line, just like this one. And this was one of the largest bull markets in history right here, and certainly the longest. And boom, it was taken out last month. Unquestionably, solid monthly close. And so far this month, we're well below the 20-month EMA, farther than we've ever been, since the last bear market. And we're also below the primary bull market uptrend line. So, like I like to say, hey, maybe the COVID's the biggest fake out in history. I mean, technically we had a bear market, if you want to call it that, but I don't. Yes, it was a drop of over 20%, but when you look at the bigger picture, step back, forget about the antiquated 1929 definition of a bull market as a rise of over 20%, bear markets. This was a several 100% bull market that lasted over a decade. You look at it this way: the primary trends: bear market, bull market, bear market, bull market. But yes, these are trend indicators, and we're below those. So this indicates most likely, and especially considering the divergences that led up to it. You don't always have them, but when you get divergent highs on the monthly chart, they greatly increase the chance you're looking at a major trend change. And when you're talking a major trend change after such a big overextended bull market, you're talking a pretty big bear market to come. I hope not. Like I say, you guys have probably heard me say that, and trust me, I do embrace bear markets. They're very profitable to trade, but for the sake of everybody else, including family members and friends that I have that run businesses and all that, I don't wish, but I can't wish it away. If it's priced in the charts, it's going to happen. It's going to happen, and therefore, I'll trade it accordingly. So that's the Dow. Let's move on a little faster. Okay, the Dow. Oh, we'll look at NDX. Hold on, QQQ. QQQ is by far the strongest index. It's the only one that hasn't, and as I pointed out, has not triggered those longest term trend indicators. But again, the QQQ is not, it is an index. It's called the Nasdaq 100 index. It consists of the 100 largest companies in the Nasdaq composite. That's the, there's thousands of stocks in the Nasdaq composite. This is the Nasdaq comp. But the Nasdaq 100 is very top heavy into a handful of stocks, overweighted. It's over 50% tech, and although it's 100 stocks, you might say, well, that's a very diversified index. No, not when half of the stocks are all in technology. And you lack very important sectors in the economy, such as financials. Therefore, it is not representative of the entire economy or even the stock market. But with that being said, it's held that 20-month EMA. You can see closed right above it last month, as well as it has even a better defined bull market uptrend line off to 2008. It bottomed. Again, this just kind of meshes with what I'm saying. It's not really a diversified stock index. Every single stock index out there, all the big ones, the Russell 2000 small caps, the mid cap 400, 500, 400, the Dow Jones Industrial Average, the S&P 500, they all bottomed on March 9th. March 6, 2009, right there. And the Nasdaq, because it's a tech sector, bottomed in the fall of 2008, and that's where that trend line comes off. But it does catch the bottom of that March 09 candle body right there. And again, it's a very well-defined, a very well-defined trend line. But it has the same technical posture all those other indexes did that did break it down. And the last bear market too, or bull market, it was also the last holdout. It was the last of those beloved FANG stocks. Back then they were the FANG, or at least that's what they were originally called. I call it FAAMG. I don't include Netflix because it's not one of the top 100, not the top 5 largest. And so I like to use FAAMG: Facebook, Amazon, Apple, Microsoft, and Alphabet, which is GOOG. All right, so that's that. So we'll watch that one, and certainly when the Nasdaq goes, because the S&P 500 is 25% technology stocks, you are all but guaranteed to see the market roll over. Because as I always said, when tech breaks, the market breaks, and that's kind of what's held this thing up during coronavirus. The market's broken down. Again, let me not mix words. The stock market's broken down. Technology hasn't, and that's my point. Is QQQ, I always say, is jokingly, is just XLK, which is a tech ETF with an Amazon kicker in there, because Amazon is not a tech stock. It's not in the tech sector, XLK, but it has such a heavy weighting on the Qs. And then the rest of them there, MDY, just to kind of make my case here. MDY, these are the mid caps. You can see bull markets going back to the 90s. Bull markets break down bear markets. Bull markets usually defined by well-defined uptrend lines that break right around the same time those 20-month EMAs the prices break below the 20-month EMA, and there it is. So these mid caps, which are a very important sector of the market, I don't cover them much because, again, the large caps make up the bulk of the value in the stock market, and that's what most people trade. You're familiar with, Apple, Walmart, Intel, all these big mega cap names. But there's a lot of companies out there in the mid cap arena, and you can see this. Whoever you are, no matter how bullish you are, you cannot argue even remotely come and stand with any type of argument that this is not in a bear market. I mean, there's your sell signal. There's the 20-month EMA, and we're off the highs, from all-time highs. When the bull market ended, it dropped 45%, but we're still down 28%, and we haven't even retraced half of the move. So by every metric available to technical analysis, this is in a bear market. Now, time may tell that, hey, the bear market ended right here, but we'd have to go up a lot. Technically, you have to take out that high. And like I said, it's certainly possible, but you can see all these trend indicators. That's the thing. You're well below these trend indicators. The trend line, the 20-month EMA. You have the divergent high that says, that was a major top. And, this would probably be one of the first bear market in history. I don't even think, going back to October of 1987, there was a little more downside after that initial leg down from the flash crash back then, or the Black Monday. But what I'm trying to get at is bear markets don't end like this. I've never seen one that end like this. You have an initial threat leg down, in a counter trend rally. Then you have another leg down. A lot of times you have these, Elliott wavers love these primary 5-wave cycles. You have wave 1, wave 2, wave 3, which is always the largest in a primary trend, wave 4, and then wave 5 where it ends. And they don't always have to end in 5-wave cycles, but that's tends. Now, even a minimum, Elliott wavers will usually look for at minimum a corrective wave and an ongoing. Let's just say this is an ongoing bull market, right? And we're going to new highs, and this thing's going to keep going for a long time. Most corrections at least evolve in an ABC pattern, ABC corrective wave. If it's a corrective wave within the larger primary trend, ABC would look like A, B, C, and then you go back to business there. And so right now we just had an A down if you look at this monthly chart, and this is B up, or the first wave up. So like I said, maybe a one and done. Is it possible? Sure, anything is possible, but is it probable based on decades of history, and this is what technical analysis is all about. That's where it came about. It's studying way back when, long before I was around or anybody really alive today. People started noticing there's repetitive patterns in the stock market, in the financial markets, and they learn to recognize those patterns to then predict what happened afterwards. And that's what technical analysis is all about. So that's it. And then finally, the small caps. IWM, same thing. 20-month EMA just does a stellar job of telling you, hey, you're in a bull market, and that's the primary trend. When it breaks, especially in conjunction with a well-defined bull market uptrend line, that's a great sell signal. That was, it doesn't get any better than that, in my opinion. Breakdown, you're in a bear market. Short back test, kickbacks to that, because the 20-month then becomes resistance. Once you take it back, great. You are back now in a bull market. Welcome to the new bull. The bear is over. It doesn't get you in and out at the bottom, but it does tell you where the primary trend is, and then you buy pullbacks to that. This was, you might say, oh, whipsaw signal. Well, you can say that if you want, but it was also a drop of over 20% back then in IWM. Small caps fell 30%, so I wouldn't exactly call that a whipsaw signal, but in the bigger picture you can, because you got you out, and there was a little more downside, but then again it told you to get back in, and it said look, and again same thing, this was over a 20% drop as well, but and so if you want to call them whipsaws, you can. That's all kind of semantics. Technically speaking, they were, because although these were drops of over 20%, again, as I said, that's an antiquated definition of a bull and bear market, because when you step back, take away all these lines, for you to, this is pretty much easy way to say it. This is a larger bull trend right here, and these corrections, they're just more so corrections that happen to be 30% or so, more than 20%. And now, what looks a little different this time around? Well, this one, those were, there's how they started, and they worked their way down. What's scary to think, if this is just the initial leg down, you put it in perspective to these other. Look, there's an ABC move. There was one down on the monthly right there. This is again a monthly chart. I will say that. Then we went down, but it wasn't a single. Look at this big red candle. And again, technically speaking, look what we have. The small caps have. This was a big support level, 128.87. We'll call it 129. Well defined. This is your primary bull market uptrend line. They've been taken out. They now become resistance. This level, which isn't too far overhead, and we could certainly get there. And this is the whole point of this video. I'm trying to impress the importance of looking at the long-term charts and also putting into the big picture. So we could, the small caps alone, let's just back out the large caps and the mid caps for a second. They are important, don't get me wrong, but just in a vacuum, from where we're at today, the small caps could rally another 8% or so and only get back to that key resistance, which would be an excellent shorting op. And they came close to it so far. And you can put up things like Fibonacci retracements as well. Their bear market started long before the large caps. The small caps and mid caps, they topped back in 2018. They've been in a bear market. And right now, that little retracement right there, look, I put up the fibs. exactly at the 38.2% fib retracement, which is if that's all that they have, that's a weak retracement right now. That's the retracement of the move off the all-time high. And you can put a line here as well and say, you might want to look at a fib off that recent kickback rally that failed shy of that 2018 high, and you're still at that 38.2. They were so close, those two highs there. All right, so that's it, and that's the bigger picture. And I say that for those that get frustrated, because we are going to be in, and we have been in a trading range. And a few weeks back I said that might be the case, that we may just slog around, mostly sideways for a while, chop around, because the one thing that doesn't fit with previous corrections when we go back is the amount of time this bear market rally has lasted. Most of in the previous ones, and I went over that with the Nasdaq composite in tech hitting the 68.1 Fibonacci retracement level. In the previous two bear markets, it hit it once and then it hit it again, or around there, around those same levels about 6 weeks later, and we just hit it recently. So time-wise, we could continue to grind around these levels, or maybe not. I don't know. Time is much harder for me to predict than price, where prices are going. But I can say this, it looks like an initial leg down. This looks like a back test of that trend line and the 20-week moving average, and it looks anywhere in here. If you're willing to give your positions enough room, and be patient, especially in time, more so in price. Don't give it 20%. Don't 10. It all depends on what you're swinging for. It's all relative to the downside. If you're looking, you short the 20-month EMA there, and you're looking for a move down here. This has been for over a year now my next bear market target, when we were still in the last bull market, and that's about 212 on SPY, and that would be about a 26% drop from where we're at. So that would entail us undercutting the recent lows by a relatively small amount. That was the highs back there from 2014 to 2016. Dow already hit that level. DIA kissed it. So maybe that was it, because the Dow hit it, but I still haven't seen it hit on SPY, and it hasn't even come close on QQQ. That tech heavy QQQ. So like I said, I think at some point in the very near future, that's the next shoe to drop, for the reasons I said. I think everybody is putting a little too much faith in the fact that technology stocks aren't impacted as much by coronavirus, and they're also, and on that same vein, then they were dismissing the fact that what's happened over the last few months and what may continue to happen going forward is not going to have much of an impact on consumer spending in the business cycle. So I think, again, there's a big disconnect, and maybe I'm wrong. Maybe everyone goes back to work and there's going to be a surge in economic activity. I have to acknowledge the Fed has flooded the system with so much cash, so much liquidity, that despite fundamentals, maybe it will bring stock prices up, to new highs. So we'll see. But as of now, I just wanted to share those long-term outlook on the market, and then we jump back to the short-term outlook, and that is what it is. Let's look at the futures real quick, and then we'll move on. Futures, same where they were this morning. We broke down took out that trend line yesterday, and we're back testing it on NQ, Nasdaq 100 futures. It's given us a small little wedge pattern right here. So you can always short a back test of the trend line. I always say the one thing about shorting back tests, whether you're buying, on a breakout, let's say you had a bullish falling wedge, it broke out and it's back testing, sometimes you back test for a while, and because trend lines are dynamic, meaning their price comes in on an uptrend line, as time goes on, the price comes in at higher and higher levels, and on the downtrend line, they come in at lower and lower levels as time goes on. The problem with a back test is you can continue to back test before rallying, and sometimes you can continue to back test, and there's no guarantee that you're going to do this. Sometimes you just kind of plop down in there and take out the trend line. So but with that being said, it's certainly objective, and as I said, the next objective, and probably even more objective entry, would be a break below that little wedge pattern, and that you have that 84 85 resistance just below. So that's the safe bet, to wait for that to go right there, and then you can see the next levels. If we continue to backtest or pop this trend line, then you have the 86.90 resistance level. That spark, that was our sell signal the other night in the futures that pointed. We broke down and backtested it. And that confirmed that as resistance. So there it is, and I'm going to give you now a little trend line here. Let's see if we can get a trend line going here. I'm not sure how it'll look. Let's grab the endpoint so we can move it. There it is. Okay, so we have, yeah, a little bit above. Look where it comes in. If I fit it like this, pretty tight, that would indicate the potential for a little more upside there. Come in, hit trend line plus price resistance, and that would be, again, a very objective shorting up with a stop somewhat above it. Let's look at ES. ES, you have this trend line here I showed you this morning, and on SPY I'm just going to extend it with a drawing tool here. And if if SPY wants to push up a little more, or ES I should say, S&P 500, 28.19 as I mentioned, plus the trend line would come in together as price resistance, giving you an objective shorting up. At this point we have a little minor uptrend line. Remember yesterday's video, I believe I highlighted this minor downtrend line, saying a pop above that could trigger a near-term rally, and that's what we've had so far. We took that downtrend line out. Now here's a little uptrend line. So there's your levels, guys. That's where this thing should, quote unquote, should stop. Objective shorting entry if it gets there with a stop somewhat above. May not get there if it breaks below the trend line, and you want to see not just ES but also NQ break below that minor trend line I gave you with that little wedge. That would increase the odds. PPO is coming to back test the zero line from below. That's bearish. This trend indicator is bearish. That's the white line, the signal line, and when it's below, the trend's bearish. So that's one thing to note there. I think, let's see if we have that on, yep, same thing on NQ, Nasdaq 100 futures. And now let me give you a few other things to look at, and we'll wrap it up. Gold. Gold's doing good today, especially I like the fact gold's rallying like this despite the dollar. Last time I looked, let me just see if it still is. The dollar was actually up. Yeah, dollar's about flat right now. With the big move was in the euro. Dollar's about flat, but yet gold's rallying. See, what happens is when the dollar drops, that's been bullish for gold, and the dollar's up, but gold's still rallying anyways. We'll call the dollar flat, really. But again, that was no surprise. I highlighted that yesterday. We had this nice little divergent low here down to support, down to that target that I put on way back here. If we broke the wedge, and that was it. We broke that bearish rising wedge, back tested it, then broke that minor support line, and then boom, had a correction right down to that 1673 target that I had back then, and hit it with a divergent low, and that's that. And here's good for a rally so far of roughly 4%. Looking good, and hopefully this is a start on the road to new highs in gold. Still an active trade on the site. I know I cover the futures a lot. Many of you trade the ETF. So here's GLD. Well, I already covered SPY. Did I get to QQQ? Yeah, either way. Here's gold. They're bearish rising wedge pattern, divergent high, everything that was pointed out back then, negative divergences, breakdown. But you had a little minor trend line there, nice clean trend line, boom, popped it on a gap up today. So that's near-term bullish. And you also had, I didn't have it drawn out here, but you had a small, just like the futures. Obviously, it's going to, GC and GLD are going to look roughly the same. You're just going to see a lot more trades, and you can sometimes sniff out some divergences or trend lines or other support resistance levels that you don't really see on gold, because you're looking at trades between 9:30 to 4 p.m. here, whereas GC is trading virtually around the clock, and that's why I like to incorporate futures into my analysis too. GC has a little work to be done. Let's see, it did already, yeah, like SPY right now. Earlier today I showed you it's struggling with gap right there. There's gap resistance. See this gap right here from the other day and all those reactions there. So we really need to pop 160, 110 to get gold going. And otherwise, we could come back in. If it comes back in, these are your support levels down below. But I favor this scenario right now. The bullish scenario, that is. Oil, I've received a few questions lately, but I've refrained from, trading oil. What's going on here? Here's USO. Now we can look at USO here, but there's a lot under the remember, USO is an ETN. It's an ETN that attempts to track crude oil by using futures, and there's a lot going on in the oil market. So we'll look at crude real quick, and then I'll show you one other thing. The common theme right now, and I talked about this weeks back, actually, when the stock market started to fall. And I talked about what's going on, and this is why the Feds come in with the, bazookas, not guns blazing, bazookas blazing. Is the financial system is a very, very complex machine. Here's some gears, and the financial system is much more like this here. You have, if you look closely behind these gears, you can, arms driving pistons. You got little gears underneath there. There's something, I guess, a little guy going around. I didn't see that in the video, but this is the financial system squared or cubed, and exponentially multiplied. It's that complex. And what am I talking about? Everything together. The credit markets, various parts of the credit markets, the stock market, commodities, crude oil, futures, brokerage firms, banks. And so what I want to talk about, and I talked about that, if we went much further down, and we already started to actually got to the point where we dropped too much too fast. This wasn't the biggest, deepest bear market in history, not even close. It was one of the most shallow so far. But where I want to go with this is, as I said before it happened, and we've started to see things break, and they're still breaking. What am I talking about? Well, okay, crude, number one. I posted this article in the trading room. I gave a link, and sometimes when you do this, you'll see these headlines, and you click, and they try to get you to subscribe. Just do this. Just copy the headline, do a Google search, and then you're going to get the article right there. I like to use Firefox. You can do it in reader mode. It gets rid of all those ads, and you can read the article. And the point is, okay, so Interactive Brokers is down big today. Last time I looked, they're 10%. We'll take a quick look at them here. I don't know where they're at, but they took an $88 million loss from the collapse in the short-term future contracts. So what happened is, okay, this is something else broke. This is what when if you're wondering what I'm talking about, things start breaking in the financial system. Okay, we had oil futures. It's kind of complicated. You have near month, next month contracts. The nearest month contract dropped to as low as minus $40 a barrel. Remember, I talked about it last week before it happened, that the CME had retasked their futures contract for the first time ever in anticipation of potential negative prices in crude. They saw the potential for this coming before it happened, and that is, and you probably read about this by now, there's just too much crude, and there's not enough storage. You can only fill all the big vats. Cushing, Oklahoma, oil tankers, they are parked at port right now. They're full of oil, and you might say, okay, well, yeah, I get it. Why don't they just stop producing? You can't. If you have an oil well, a lot of oil wells you can't turn off the flow of oil, or you can permanently damage that well. You might not be able to bring it back online again. Once you crack into the ground, that oil's coming up through the pipes. They got to keep going, or else things get all mucked up. So what happens is negative oil prices means some producers are technically having to pay. They have to keep pumping to keep the wells going, and then pay to take it away. But this is more of, you read through this article, and that's why I post it in the trading room, is a lot of that they talk on here has to do, they suspect, with ETFs, ETNs, and they're trying to square away. I told you that 2 of them blew up. I warned you about what was that, UWT and DWT, those 3-time leveraged short ETFs, which are gone now. They blew up, meaning you lost every penny if you didn't get out of them before the company ceased trading on those and retired those. And so now this is Interactive Brokers. I bring this up because, look, I have, when the financial system starts to have cracks and things start to break, you need to be concerned. That's, again, it cost $88 million to Interactive Brokers, not because they had their hand in the cookie jar, because their clients did, and they had to issue margin calls because if anybody who was long crude, and too many people were, they were long crude. it dropped so much, the value, futures are highly leveraged, that the value of their contracts exceeded the value of what they had in their account. So let's say you had a $1 million account, 100,000, whatever your number is, you exceed a loss of 100,000, or they blow you out. So they had to, but they blew them out too late, went down too fast. And so what happens is Interactive Brokers, although they weren't shorting, it was their clients shorting crude or long crude, they got the margin call that got wiped out. Interactive Brokers is on the hook to pay the exchanges, to clear those contracts. And so that was $88 million hit. Of course, their CEO said everything's fine and it's probably not going to affect, our financial standing still good. They always say that, but we're going to take a look at this because, again, my whole goal, other than giving you trade ideas, is how to navigate the, the next bear market. And these are certainly, I don't want the right word, precarious times, if you will, precarious situation here. With a lot of these ETNs blowing up, I have to imagine somebody listening to my voice has owned one of the over 24 ETNs that have blown up in recent months. And I'm going to pull up Interactive Brokers. Now, the thing here is, I don't care to short the stock, but I'm going to make, first of all, there's a very good technical case for shorting it. You look at the, this is a daily chart. Look, we rallied right back to a beautiful trend line. We had this symmetrical triangle right here, broke out, failed, came down. We recently backtested 1, 2, 3 times before this whole thing even happened in crude. So the charts were even predicting this big move down. I talk about that PPO signal line, the zero line, being a great trend indicator, bearish when you're below it, bullish when you're above it, and also how it's not good when you're in a choppy sideways market. It's good for trending markets when you have clear separation and you're well below the zero line. That's when it defines trends really well. Bearish trend, we don't really have a bullish trend there, a short one right there. And you can see, as I often say, that zero line acts as resistance when tested from below. And look at it rolling over right there. And boom, a big drop today. We were down over 10%. Now we're down 8.61. But where this warrants watching, again, the CEO came out, said it's not going to affect us. That certainly, yeah, they cost them $88 million, but they're saying, well, we're still okay. Maybe, but let's just keep an eye on this. I'll keep an eye on this because I have several brokerage accounts. I spread my money around. I do that for other purposes too. Also to some charting platforms that different brokers are better. I like to run TD Ameritrade's Think or Swim. I like to use, sometimes I'll use Fidelity, some other ones. So I have money scattered among different brokers, but get a good chunk of change here, and I'm going to watch this. Why? Way back in 2011, I did this post. There was a company back then called MF Global, and they were one of the biggest. They were big with futures and everything else as a brokerage firm, and they went kaput, belly up. They had their hand in the cookie jar. They were commingling their assets, customers' assets, with the firm assets, thereby circumventing the normal firewall process, which should have protected the client's assets. But here's a point: there was a tell. And I posted this chart at the time. The tell that something was rotten in the state of Denmark, or at least in the state of MF Global, was the fact that this candlestick is MF Global's price. And you can see up here I have the S&P 500 and the broker-dealer index, XBD, in the white line. So really look at MF Global. Trade nearly lockstep in with the brokerage industry, as it should, other brokerage firms, because they're all doing the same thing. Sure, one broker might be a little more competitive, might have a niche here or there, but their profits and their stock price as such ebbs and flows with financial conditions in the market. When trading is up, trading volumes, things, they do well. When it goes down, they do bad. And so most brokers are going to move roughly in lockstep. As I like to say, birds of a feather flock together. But where you get a tell is all of a sudden, here's where the tell started. Right here, they were tracking, was tracking almost perfect to the sector that it's in, and then all of a sudden there was some divergence here. Well before MF Global went kaput, it started going down while the brokerage index was going up. All the other brokers, TD Ameritrade, Interactive Brokers, anyone else publicly traded in this index. So why is that? Well, little birdies tend to fly around and tell other little birdies things that they shouldn't be. Smart money knows. This is insider trading. There were cracks developing at MF Global, and now it's a big drop. Now you might say, oh, that's small divergence. No, look where it went from 750 down to about 450 before the news came out. So this is what I'm going to watch, because there is no more accurate predictor of stock prices than the charts. If you trade reading headlines and reacting to headlines, I'm telling you, you're trading like driving in the rearview mirror. By the time you read or hear about something, there are some headlines that move the market, don't get me wrong, but most often it's already priced in fully or mostly. What I mean by that is maybe something's, stock's been going up with no news. All of a sudden there's a news headline and it spikes up big, but then that's usually a selling climax. See, the smart money was buying it by the time the public read about it, and the headline comes out, there's a big spike, and then it's faded. And so this is, again, just a tell, and that's all I'm trying to say here. So we're going to watch that. I've already looked at interactive broker. Here, I'll even show you. Let me pull off all these lines right here and show you what it looks like against the broker dealer index. XBD. And you can see again, that last chart was 2011. Here's that case in point. Let me do this. Edit chart properties. Okay, they're not starting at the same point. That's what I wanted. So you can see again, as I said, birds of a feather flock together. Interactive brokers, as it should when everything's fine. If this interactive broker stock is dropping and the whole sector's dropping, that's fine. That's just the ebb and flow of the brokerage sector. And that's what you want to see, them heading in the same direction. So right now, that's not the case. At least they're vastly outperforming. Now, as I always say, one day doesn't make a trend. So please, I'm not hitting the panic button right now. I'm just saying this is something to watch, because let's say the market continues to rally. Let's say my outlook on the market's wrong, and or whatever reason the brokerage sector goes up or just holds up and trades flat, and Interactive Brokers keeps doing this. That's going to be a tell. And at that point, I'm probably going to move some of my money or all of my money out if the stock market is telling me something that the headlines aren't. Here's the CEO again, came out, said, oh no, we're fine, we can take that $88 million loss. There's also an investigation, or maybe a pending investigation, in that article. I think it said somewhere here that where did it go? That no one missed the margin favor. That reduces counter. Yeah, here it is. IB is working with authorities reviewing its past anti-money laundering practices and privacy practices. The SEC and CFTC and FINRA, which oversee brokerages, have indicated they believe Interactive Brokers' historical practices and procedures were inadequate. So whatever, that's not probably too big. Again, I'm not trying to worry you. Just, hey, something let's keep an eye on, because going back to what I said, there's a lot of cogs in the in this giant machine called the financial markets, and that's what I think we've seen. We've seen one after another break down. These little gears break here, and this is the Fed. Another good analogy, if I had a picture of imagine a big dam right here, the waterfall, and the dam has a bunch of leaks spurting out. The Fed's sticking fingers in all these holes, but you only have so many fingers, and you can only plug so many holes. And if the dam breaks, if too many of these gears break, all these gears stop spinning, and that's bad. Now, we're not there right now. We're having a nice relief rally. Credit markets are certainly stabilized for the time being. But I do this, and I talk about this now, because you don't want to wait till something big breaks. Because if something big breaks, this market could be lock limit down tomorrow. And if it's ever going to break, if any point in history, recent history, if the stock market's ever going to break, where some big, what would be a big break, a major bank or brokerage firm like Interactive Brokers failing, because then it causes a domino effect that has additional repercussions within the financial sector. And so when you go back in time, if there's ever going to be a time that the financial system is at risk of breaking, it's not here, it's not here, it's not here, it's usually here. Especially here with these very fast drops that come out of nowhere because the market is caught off guard. banks, their trading desks, hedge funds, pension funds, individual investors are caught off guard and suffer those big losses, which then lead to forced margin sell and everything else. And again, so we just saw another crack the other day with crude oil here, going to negative prices, and now at least one broker coming out, and that just happened. Let's see, there might be some other brokers there, but I'm guessing Interactive Brokers tends to cater to the professionals, so they probably have a lot more investors shorting CL crude futures, whereas my guess is TD Ameritrade probably has more of them playing the ETFs and ETNs like USO and the now defunct DWT and UWT. And speaking of that, for now, USO is fine. Somebody asked me about it. It doesn't use leverage, but it is an ETN, and it is tracking crude. And right now, crude's all over the place because of the, not just the excess supply of crude and the collapse in demand. That's certainly a big part of it. But I think the bigger risk is futures have become a playground for speculators. Future contracts were originally put out to allow producers and the end users of crude oil to hedge. Airlines could hedge their fuel costs. Producers could, more accurately, hedge against, price swings and all that. But in over the past decade or so, the big banks and firms, even individuals, have just, are pure spec. Nobody, I don't know what the percentage is, but I had just a very large percentage of those, futures contracts that are traded are from individuals or institutions that have absolutely no interest in taking delivery of that crude. And that is what happened too, is that then those contracts were coming due and nobody wanted delivery, so prices collapse. You can speculate, what am I going to do if I had a crude contract that was coming due last month, where I'd had to take delivery if I didn't close it out? What, I'm going to fill my swimming pool with how many thousands of barrels each contract represents? So that's kind of what happened there. All right, let me wrap it up here. Like I said, the beginning of this video kind of start out, just look at the charts. That's not what I wanted to flip to, but I'll keep an update on crude, but I'm staying away from it right now. Let the dust settle. At this point, it's almost a gamble. Especially, let me say this, especially if you're an ETF trader or ETN trader, because what happens in the futures overnight, crude's swinging up and down 20+% a day right now. And if you take an ETF or ETN like this, you have no control overnight. You can't set your stops at any point. You can wake up to a huge gap down. And I mean, there's one example right there from where it closed to where it opened the next day. That was a 13% gap down. So how do you manage stops? If you had a 3-4% stop, it would have been bypassed and either filled at the open if you had a stop loss order. Good, that turns into a market order once your stop price is exceeded. Or you say, oh, I'll use a stop limit that says fill me at and only at 371 if it goes there. Well, guess what? It doesn't get filled. A stop limit order will not execute unless the stock gets back to 371. So you would have rode down a 38% loss into the lows on that. So there's really no way around protecting yourself, short of buying options, which then get expensive and make it not worthwhile. So just like I said, stay clear of this until the crude markets stabilize. That would be my suggestion. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.